it's just people are they don't really get any wiser about this sort of thing. Somebody else fire, they're going to run for the door. I mean, it's built into fear is so easy to arouse in people. And you talk about fear about their money, and they don't really understand the system necessarily or anything of the sort, and they can actually, by their own actions, then create what they were afraid of. People are still scared when they get scared. And being scared is so contagious. You can't imagine what it was like that weekend after Silicon Valley. I mean, the guy that drives me around because I can't see that well, and all he was talking was banking, and he was, what should he do? And it's unnecessary fear is a terrible thing.
That was a clip Warren Buffett describing the fears he witnessed in the weeks after the failure of Silicon Valley Bank and the Silvergate Bank. I'm sure you also saw the countless headlines in the financial media talking about this may be the start of another banking crisis just like 2008, where the bank failed one after another like a domino. But is this fear warranted? If you have deposits in the bank and your bank went bankrupt, do you need to worry about that you may never be able to get your money back? Let's hear from the one and only Warren Buffett himself.
So let's talk about what's happening in the banking sector right now. Is this a banking crisis? Is this financials in turmoil? Is this banking crisis 2.0? What would you call what we've been seeing happen?
Well, I would say that some of the dumb things that banks do periodically, has become uncovered during this period, and as one of the banker told me one time, he says, I don't know why we keep looking for new ways to lose money when the old ones are working so well. And they made the same mistake, some banks in this period, by they haven't made as many mistakes. They expect to make some mistakes in making loans, but they haven't, and particularly if you're getting into credit card loans, I mean, that's just part of the game. But they haven't made it the same sort of mistakes that they made back in 2008 or 9.
Okay, so Warren has clearly said that the issue this time around is not as bad as what we had in 2008. He obviously thinks that the banks have made mistakes, but the mistakes were kind of restricted to a few banks, not to the entire banking system.
But they have mismatched assets and liabilities, and bankers have been tempted to do that forever, and every now and then it bites them in a big way. And I mean, it is accounting procedures have driven some bankers to do some things that may have helped their current earnings a little bit and caused the recurring temptation to get a little bit bigger spread and report a little more in earnings.
So Warren did call an issue with the banking sector, and that is using accounting techniques to mask their losses. He thinks that the bankers and the management were not transparent enough to the investor in 2008, and that hasn't changed at all.
It's just amazing to me that banks could make presentations to financial analysts and everything, and if one bank bought a bond at 100 and another bought it at 96, and they both held a maturity, one bank carries it at 100 and another bank carries it at 96.
Now, let's try to understand the treasury bonds example Warren just mentioned. Just like stock investment, treasury bonds can be measured at market value or at cost, being the purchase price. When we measure the value of our stock investment, it makes sense to use market value because that is the amount of money that we will be able to get if we sell those investments. However, some banks choose to measure the value of their treasury bonds by historical cost. This means the banks can avoid showing a loss on their financial statements no matter how low the market value of the bond is. This is exactly how SVB was able to hide billions of dollars of losses from investors.
And then once they start looking at one that does it, then they start looking at others, and pretty soon, that everybody is in a position of looking at a number that nobody looked at when it was presented to them a year ago. If you read the 10K or anything of the sort, but the banks did not call attention to what they were doing when it was going on, and I would read investor contact when they would have meetings with financial analysts or the people who follow banking, and nobody even brought up the point virtually.
Of course, the example above is just one of the earnings management techniques. These techniques, in Warren's words, are recurring and everywhere. I mean, these salesman approach are so different from how Warren treats his shareholders. If you look at Berkshire Hathaway's shareholder presentation documents, you immediately notice how plain those documents are compared to the others. There's no fancy graphics, no marketing slogans. On the front page, Warren listed his performance for the past 58 years, all the way back to 1965. If he made a mistake, he feels the obligation to let people know, and he's not afraid to admit it.
And believe me, if we've got a $50 billion loss or something in Berkshire, we would expect people to know about it. And it's happened before. It's happened this time. It'll happen again someday.
Banking crisis at this point.
We're not through with bank failures, but we are through the depositor. The depositors haven't had a crisis. People shouldn't be worried about losing their money in the deposits they have in an American bank. And today they have no reason to worry. So you don't need to turn a dumb decision by managers into a panicking the whole citizenry of the United States about something they don't need to be panicked about. I mean, it is really, it's like we thinking that I just don't know why you do it with people. We set up the FDIC to relieve the worry of people. And initially, it wasn't the same institution
but
it is now.
You're saying on one hand, okay, no depositor is going to lose money. On the other hand, you're saying we're not through the bank failures.
Banks can go bust, but depositors aren't going to be hurt. I mean, banks can go bust. I mean, the Continental Illinois Bank was thought to be impregnable, back many years ago. And, the Franklin National Bank, the Bank of the Commonwealth, and sometimes they go broke because they make too many dumb loans, and sometimes it's because they mismatch maturities.
Okay, there you have it. Warren Buffett unequivocally said that as a depositor in the United States, you do not need to worry about losing money. Why? Because the government agency called the FDIC. What is FDIC, you ask? Well, let's hear from the man himself.
The FDIC is in effect, a very peculiar mutual insurance operation that is run by the government but is financed by the banks. And FDIC had $120 billion or so at the start of the year, and that's all money that banks have paid in, less what the FDIC has had to pay out on losses. If the FDIC has to pay out $250 billion this time or $300 billion, they just assess the banks more. And they don't do it in a very business-like manner because the public has the impression that the FDIC is the United States government and that so on. And of course, they do appoint the people, but the costs of the FDIC, including the cost of their employees and everything else, is borne by the banks. So banks have never cost the federal government a dime, but that the public doesn't really understand the whole FDIC thing, and the comments of public officials confuse it and the issue enormously. Somebody ought to write. I mean, the FDIC was set up to operate on, I think, January 1st, 1934. You'd think somebody would have gotten through to writing what's the essence of this FDIC, which was a fantastically good development of the New Deal.
Okay, now let me unpack that for you. FDIC, Federal Deposit Insurance Corporation, is a government agency that acts like an insurance company, but for banks. In the case of a bank failure, FDIC will step in and guarantee your deposit in the United States. Obviously, this insurance is not free, and the bank has to pay a premium based on their risk profile. Since FDIC insurance began in 1934, no depositor has lost a single penny of insured funds due to bank failure. That's almost 90 years of track record. That's why Warren is so confident about the safety of our deposit in the United States. Okay, depositors are safe because of the FDIC. What about investors like shareholders? Are they safe? The answer is no. FDIC does not provide insurance against shareholders' interest. Take a listen.
The owners of banks may have lost a hell of a lot of money. The people who bought the debt of the holding company, they may lose a lot of money. They can lose a lot of money.
So Warren is very clear here. He's saying that there may be more bank failures coming and investors will lose money in those type of situations. In his view, banks, in essence, are no different to other businesses. If the management consistently make poor and risky decisions, then that bank will fail, simply because that's just how capitalism and market works. It is worth noting that Warren sold all of Berkshire's bank holdings other than the investments in Bank of America. I mean, that really tells us how Warren thinks about banking sector as an investment. As for the reason why he sold his banking positions, I suspect it has a lot to do with the lack of trust issue that we talked about earlier. But he also brings up an interesting point, basically saying that the banking system currently is not working. Take a look.
Some of the banks that you've sold include USB, Wells Fargo, Goldman Sachs, JP Morgan, PNC. Should we think that they're banks that aren't well run because you've sold them? Or?
No. But I do think, I did think that banking could get in a lot of trouble just because of the kind of things that they did, and that I didn't like the banking business as well as I did before. Banks that we'd owned for 25 or 30 years, and if they asked me why I did it, I told them. But and I like the people. I mean, I just think the system isn't set up quite right in terms of connecting punishment to culprits on something that's it's incredibly important that your banking system run well in the country. I mean, it just isn't going to work unless you have a banking system that works, and you don't want them to create periodic crises unnecessarily.
So what I hear him say is that the current system does not impose enough punishments to the bank's directors, managers for making reckless decisions and taking unnecessary risk. So those people will most likely keep exploiting and gaming the system because the cost of doing so is outweighed by the financial benefits. Alright, I've certainly learned a lot from Warren's interview. In summary, he's not seeing a 2008 scale banking crisis this time around. Although there may or may not be more bank failures in the near future, he's very confident that depositors' money will be protected thanks to the proven track record of the FDIC. Remember, shareholders' interests are not protected by the FDIC, and Warren has exited most of his banking positions. Alright, that's everything that we have for today's episode. Thanks for tuning in, and I will see you next time.